In this video, we're going to look at some of the valuation issues regarding notes receivable. And this is a continuation of what we discussed before in terms of accounts receivable. So if you look at that video, accounts receivable, you'll remember that I said that the value of a receivable depends on a few things, like discounts, like the uncollectibles, but also the maturity date, right? So if a receivable is less than 1 year, then we record it at face amount. And if it's more than a year, then we record it at the present value of future cash flows. So the same thing applies here with notes receivable. So this is interchangeable. Whatever type of receivable it is, the rules still apply. Normally, the difference between a note receivable and an accounts receivable is that the note receivable is a more formal agreement where it can be most of the times a longer term agreement where there's interest involved, whereas some of your accounts receivable most of the times are just short-term type arrangements. But if you have a note receivable, usually the note itself will have the interest that's stated. So you might have a note that's what referred to as interest bearing, and most notes are structured that way. So under that interest-bearing note, you'll have a stated amount of interest that needs to be paid, and that would be the stated rate. And then you also have some notes that are specified as non-interest bearing, and this can be misleading because a lot of times when you have a non-interest bearing note, it's more of a you can think of it as a marketing approach to try to entice customers to buy things, perhaps, or a service. But from a business perspective, from an accounting perspective, even though it's non-interest bearing, we still have to compute some form of interest within that note, and that is referred to as imputing interest. And I'll talk a little bit more about that in a minute here. Okay, so most of the times you'll have the interest amount stated, but if it doesn't, you'll have to impute interest as the transaction, or for the transaction rather. Okay, so valuation of the receivable. Straightforward. If it's a short-term note, then it's at face amount, just like we discussed before. And if it's a long-term note, more than a year, then we have to value that at the present value of the future cash flows. Okay. There's also another valuation approach that is an option for a company, and that's to mark your notes at fair market value. And that's referred to as the fair value option under GAAP. So while this is recorded at face amount, this is recorded at the present value of future cash flows, this would be recorded at the fair market value. So at inception, these two will probably be the same, but then as time passes, you might have to change the value of the note according to what market conditions change, and update the value either up or down if you choose this. Okay, if you choose the fair value option. Now we're going to concentrate on these two right here, right now. This is the fair value option is a topic of a later chapter. So these two are the ones we're going to look at. So here's this quick, simple example, and it could be as simple as this. This is a short-term environment. Company sells $300 worth of services or goods to be paid in 30 days. So here, this meets the short-term criteria. So we would value this transaction, or we would value the exchange at $300. So in other words, we would record notes receivable and corresponding revenue for that amount of $300. Later on, when we get the cash, we increase the cash and then eliminate that note receivable. So that's straightforward, just like in your accounts receivable. But if on the other hand, the company sells that same service or product for $300 and it's to be paid in 2 years, then at that point, we have to consider the fact that there's interest involved. Whether that interest is stated or not stated, either way, we have to consider the interest component of that transaction. So what we're saying here is that assume, don't worry about the interest rates right now. We'll do a comprehensive example in a minute here, but assume that the interest amount is $35. So if the interest amount is $35 here, based on the discounting, the present value of future cash flows, based on that discount approach, it's $35, then we would say that the real value of that exchange is $265. So that's why I note here the value of the exchange under this long-term environment is 265, the present value of the future cash flows. And then what would happen is that later on, when we receive the whole $300, we would have interest revenue of $35, and then we would reduce the receivable for the original 265. But notice what we're doing here with this transaction. We're recognizing revenue from operating activities as 265, and then we're recognizing interest revenue of 35 as another type of revenue. So we're not bulking the two types of revenue together. We're distinguishing that one is related to our regular operating activities, and then that another revenue is related to the fact that we allow financing for our customers. This is sort of a function. Your function is as a bank as well. Okay, it's because you're lending money. This is a tip. Will be, you really don't see it as a loan, but it is a loan because you're allowing somebody to pay in 2 years, right? So you could, and I present the net method here, or you could do the gross method. You've seen before how either method is correct. If you do the gross method, you would put it at $300, the note receivable, but you would have this contra notes receivable account called discount on notes receivable. So if it's a contra notes receivable, you're still valuing the note receivable at 265 because of that contra account. So then later, when you get paid the 300, you eliminate that discount account and you recognize that interest revenue and then remove the note receivable for 300. Either way is fine. There's no preference here. It's because it's the company's choice as to what approach they take. Okay, so that's a simplistic way of looking at it, but here's what I want you to see big picture. Under the short-term environment, the value of the exchange is $300, the value of that transaction. Under the long-term environment, the value of the exchange, whether you use the net method or the gross method, the value of that exchange is 265. And that's a very important thing to be able to understand, that the value of that exchange is 265 because of the fact that it's long-term, even though it's stated as being $300. This is imputing interest. Let's say this was a 0% loan, a non-interest bearing note. Then at that point, we would have to go in there and impute this $35 of interest. Okay, let me show you a more involved example here. So assume that a company on July 1st of the year X4 sells land that is worth $700,000. Put a K here. It's worth $700,000, and it is sold in exchange for a 4-year, 0 interest-bearing promissory note in the face amount of $1.1 million. The land is carried on the company's books at $590, and then the customer normally borrows at 12%. So look at some of the issues that are occurring here. We tell the customer that we're going to sell this land to them at this price, and that they don't have to pay us that $1.1 million until 4 years from now, and that it's 0 interest bearing. Okay, so that's what you tell the customer. Now, internally, we need to know what the present value of that 1.1 million is. And even though we said it was 0% interest, we're still going to figure out what the customer's risk profile is. In this case, the customer usually borrows at 12%, and we determine that that's their corresponding rate, the customer's corresponding rate. So we'll have to go in there and do the present value of $1.1 million at 12% for 4 periods. Now, that gives us $700,000, and we would say that this is the worth of the exchange, the value of the transaction. Now, notice that we had that information over here, but normally you may not have that information, and this is how you have to determine the worth of the exchange. So on July 1st, X4, this is what I would do if I were using the gross method, right? You can also use the net method if you want. So I would put the notes for 1.1 million. I would have a discount of the difference between 1.1 million and $700,000. And then I would remove the land from the company's books at original cost of $590. and my gain would be $110,000. Now notice that there's two things going on right here, and you want to make sure you're clear on this. One of them is the accounting for a note that is worth $700,000, and that's what we're doing with these two parts right here. Okay, this is an asset, and this is a contra asset. Okay, and then that gives us $700,000. But at the same time, we're also accounting for the fact that we're selling something for $700 that cost us $590. So that gain of $110 is structured right here. Now, don't lose sight of the fact that the value of this exchange is $700,000. Okay? What happens next is that as time passes, we're going to have to recognize some of that interest that is earned over time. So for example, assume this company has financial reports that are presented at the end of the year. So between July 1st, X4, or whatever that year may be, until December 31st, X4, 6 months have passed. So because 6 months have passed and we're trying to prepare financial statements as of 12/31, we need to recognize how much interest has accrued and how much interest we have earned during that period. So we would take the carrying value of the note. Whenever you're computing the interest, you always do the carrying value of the note at the beginning of a period times the market rate. That gives you the interest amount earned or incurred if you're paying it. So let me change this a little bit here. So keep this formula handy, because this is always going to be the case. You always, in order to compute what interest is earned or what interest is incurred, the actual amount that's incurred or earned, you always start with the carrying value of that instrument, that loan, at the beginning of a period times the market rate. So I know that the carrying value of this note at the beginning on July 1st is $700,000, because it's the full amount, the gross amount, minus whatever's in the discount. Now notice I did a little T account here for the note and a T account for the discount, and it just helps me visualize what's going on right here. So carrying value on this date is going to be 1.1 million minus 401, which is what I'm doing right here. 1.1 million minus 401 gives me 700,000, and that's what I'm going to use right here to compute the interest earned for that 6-month period. So it's 700,000 times 12%. Keep in mind, we told the client that there was zero interest, right? We told the customer zero interest. But internally in our books, we have to go in there and impute that interest of 12%. So that's 12%, and then since this is for half a year, 6 months out of 12, then we do that at time factor adjustment. And this gives me $42,000. So I will reduce the discount for $42,000, and I'll recognize interest revenue of $42,000. And if you want to keep track of this, I've posted it here in the discount account, and then that gives me an ending balance of $359. And this $359 is important because that's going to help me determine the carrying value for the next period. Okay, so what happens next? Here's 12/31/X4. We computed the interest, we recognize some of that interest, and now we're going to assume that a whole year has passed. We're now at 12/31/X5, and we're going to do the adjustment for interest earned. Now, keep in mind that normally companies will be doing these adjustments at a minimum quarterly, right? We're going to simplify right here, and we're going to do an adjustment for the whole year, but normally you'll have quarterly or even monthly adjustments for this kind of stuff. But we're going to do a whole year adjustment. So now the next question is, if we're going to use the same formula here, okay, we're going to use the carrying value at the beginning of the period times the market rate. So I'm going to go in here, I'm going to go 1.1 million minus the ending balance of discount. So that gives me a carrying value of $742,000. So I'm going to compute that, 742,000 times 12%. Since this is for a whole 12-month period, I don't need a time factor adjustment, and that gives me 89,040. reduce the discount, and then my interest revenue recognized of 89,040. And notice how as we recognize this interest, the discount account goes down, right? The balance. Because eventually that discount account is going to reach zero as we amortize over the 4 years, or more specifically over the 48 months, right? Because, you know, this was 6 months here, so we're going to have to add an extra year with 6 months. In total, we need to amortize over 48 months. So that's what I do here. Let's say we go to the next year, 1231x6, and we do the discount. I'm not going to do the math, but you would do 1.1 million minus 270, and that gives you the carrying value. That carrying value would be used to compute the interest at 12%. So for sake of conversation here and making this quickly, I'm going to say it's X that gets reduced. And then later on the following year, we're going to do 6 more months in order to get the whole 48 months worth of amortization. Actually, my bad here. This would be another year, another full year. I missed one 12-month block here. My apologies. So let me correct this real quick, and then I'll get back to the video. Okay, so here, let me make sure we're clear on the error I had. In total, we need to amortize 4 years or 48 months, right? Since we had six months here, we had 12 months here, that's 1 year, 12 months here, that's another year, and then we need another 12-month period, which I had not included. So that gives us 3.5 years up to here. So then on X8, that fiscal year, I need 6 more months, and then that fully amortizes the note. Okay, so each one of these you'll have to do the corresponding computation for, giving you X, Y, and Z. But the important thing for you to see here is that after I do all these adjustments for the interest that we earn, from the 42,000 all the way to Z, the balance in the discount account at the end of this 48-month period will be 0. And the carrying value of that note at the end of the period is just going to be the full $1.1 million. And that's the whole idea there. It started out as a value of 700,000, right, as a carrying value. But as we recognized interest, that value kept increasing, and the mechanical thing we were doing was reducing the discount account every time. So at the end of the 48-month period, on June 30th of X8, you're not only going to adjust for this interest earned, but you're also now going to receive the cash payment from the client. So you're going to debit the cash, you're going to increase the cash for that 1.1 million, and you're going to eliminate the note, the original note, you're going to credit it for 1.1 million. You don't have to do anything with the discount anymore, because recall that now you fully amortize that discount, and that discount is 0. Okay, so a lot of things going on in this particular problem from the perspective of what we're talking about right here. The big picture is we're talking about valuation of notes receivable. And in that context, make sure you understand that even if whatever we're told in the transaction, 700, 590, 1.1 million, 0 interest, you have to gather all that information and say, well, what's the value of this exchange? And based on this information, we have a client that's going to pay us 1.1 million in 4 years. So we got to figure out what the present value of those future cash flows are. And that's this right here. Now, it happens to be that there's only one future cash flow, which makes it easy for us to compute the present value. But sometimes you have more than one cash flow, and it doesn't necessarily make it more difficult. It's just more math that needs to be done to be able to determine what the full present value is. So let me give you an example of something like that. Let me give you the second example here. So assume that on July 1st, X4, a company rendered services in exchange for a 3%, 8-year promissory note having a face value of $400,000. And then on top of that, there's interest to be paid semi-annually, and then we're told that the customer normally borrows at 12%. So a lot of things to consider here. The first thing is that, again, we're giving the client a rate that is lower than their actual borrowing rate. And even though we tell the customer 3% for this note or this borrowing, really the interest rate for that customer is 12%. So somehow we're going to have to impute part interest. So we're recognizing 3% of the interest, but this is not 100% accurate in terms of the math, but we're going to have to impute 9% more. Okay, and let's see how that happens. Okay, we're going to look at the present value of the 400,000. That's the first thing, right? We're going to receive 400,000 in 8 years. And since this is semi-annually, that'll be 8 times 2 semi-annual periods, so that's 16 periods. So we'll do the present value of 16 periods at 12% APR. This is annual. So since we're doing semi-annual, we're going to have to put this half of this. So this is 6%. So to compute the first component of the future cash flows, this is one of the future cash flows, we're going to do the present value of 400,000 at 12% annually or 6% semi-annually for 8 years or 16 semi-annual periods, and that gives us 157,459. Now, what's the other cash flow that occurs here? The customer is told or has a contract that states that they'll pay 3% per year on 400,000. So 3% of 400,000 is $12,000. Now, if we do that semi-annually, that's $6,000. So on a semi-annual basis, I'm going to have to also compute the present value of those cash flows. This transaction here has two sets of cash flows. It's got the 400,000 that we'll get in 8 years, but it also has a payment of 6,000 that we get every 6 months. So that's a future cash flow as well. So I'm going to compute the present value of 6,000 at 6% for 16 periods, and that gives me $60,000. So when I sum this up, I get $218,000. And that right there is the value of the exchange. And this is where it gets a little tricky, right? But we have to be able to determine this. Even though we state 400, even though we say that there's payments of 12,000 per year in interest or 6,000 every 6 months, we have to break all this apart and determine that really the sale that's taking place right now, the sale or the provision of services that's taking place right now is worth $218,000. That's what I mean here by the value of the exchange. So we will record this transaction on this particular date as a notes receivable of 400. This is if you're using the gross method. And then you're going to have a discount that offsets the 400 to be able to recognize the revenue of 218,094. Now, if you'd like, and I think it makes it easier, look at this amortization schedule I prepared right here. Notice how the balance starts at 218,094. This is like a loan. And then 6 months from now, there's a $6,000 payment that is received. And you can think of this as the 3% amount that is stated that is going to be paid. But then the actual interest is $13,086. And how do I compute that? Well, remember this formula, carrying value at the beginning of a period. Let me just copy it over. This is getting very busy here. Carrying value at the beginning of the period times the market rate gives me my interest earned, right? That's always the case. So for this 6-month period, I'm going to first look at the carrying value, which is 218,094. That's the carrying value at the beginning of the period. Let me just put this somewhere else. But this formula you will always want to keep in mind. This is how you compute interest earned or interest incurred. So that's 218,094 times market rate, and then for half a year, and that gives me 13,086. So this 13,086 is the interest revenue that needs to be recognized for that period. Now, after this is done, notice that we get cash of 6,000, even though the interest itself is 13,086. So what we have is amortization of 7,086. Now, don't get confused, but this would be referred to as negative amortization. And the reason it would be considered that is because the value or the carrying value of the loan is going up. Normally, when you have a loan, the carrying value goes down. But in this case, the carrying value is going up. So this is the opposite of what normal amortization is. Nothing wrong with it. That's just the mechanics of it, okay? So as we keep amortizing this loan here, notice the carrying value of the loan goes up, and it eventually reaches $400,000 because that's what we are going to collect at the end of the 8-year period, at the end of the 16 periods, semi-annual periods. Okay? So how do we do the journal entry or the recording for this? Notice how the summation, I do it in 2 journal entries. You can combine it if you'd like. It doesn't matter. But the key here is, notice the 2 I highlighted. The 2 I highlighted is for interest revenue. And I happen to do them separately, okay? But you can choose to do it as one. But notice how this sums up to the 13,086. And it might help to put this in green so that we know what that's all about. Bear with me 1 second here. So notice this 786 and 6,000 is the 13,086. And I told you this is the interest revenue earned. So that's what we're going to recognize for that 6-month period. Now, I receive cash of 6,000, so that's why I'm putting here cash, or if it's going to be paid later or the next day or whatever, interest receivable, but it's money that's coming in. And then the difference is what gets amortized to the discount. This is what we looked at right here. So for a problem like this, I always create the amortization schedule just to give me everything and make sure that it works out to the correct amount. You know it needs to work out to 400 because that's the future value and that's what it has to be. Now, I also do the T accounts here if it helps you to look at these T accounts. We have the notes receivable at 400 from here. And then here's the original discount of 181,906. Once I amortize 7,086, my ending balance is this amount right here. As the amount of the discount goes down, the carrying value of this note goes up. That's this right here. As the discount amount goes down, the carrying value of the note goes up. Okay? So let me do the second period just for sake of illustration, and then we'll stop there. But for the second block of 6 months, I need to know what the carrying value is at the beginning of the period. So I refer to my amortization schedule, and that's this amount right here. Or if you wanted to, you could subtract 400 minus 174, and you'll still arrive at the 225, 180. So several ways to do it. But at that point, I'm going to multiply times 12% and then consider the time factor, so half that basically, and that gives me 13,511. That's what this is right here. So again, we'll recognize 13,511 of interest revenue, and then we'll reduce the discount for the amount of amortization that we say should be right here on the amortization schedule. And it's basically the difference between whatever you're recognizing in interest revenue minus 6,000, because that's what you're receiving in cash. And this will continue every 6 months until you reach the last adjustment. So when you do the last adjustment, it'll look like this, except the numbers will be different. The summation here will total 16,981, right? This will be 6,000, but this will be whatever you need to get to 16,098. Oh, my apologies. I said that wrong. This is going to be 6,000 of interest revenue. And then this, for the last one, I'm talking about for this one right here, the last one, you're going to have 16,981 right here. And then the summation of those two will be 22,981. Same procedure, so you just keep following. You'll do that, and then finally you'll also receive the $400,000 of cash. So you'll debit cash, because cash is going up for 400, and then you'll reduce the notes receivable for the 400. Similarly to what we did in this first example, where you have to finally get the money, the future value, the amount of that note, so you'll get that amount. Okay? So big picture here, folks, in all the examples I gave you, big picture is that whether you're dealing with a short-term receivable or a long-term receivable, a key thing to keep in mind is for you to be able to understand what the value of that transaction is. That's a big deal for us accountants. Because notice, this same information can be handled very differently depending on whether it's short-term or long-term, right? The value of the exchange, $300 here, but $265 on this scenario here. And as we get involved in more convoluted type transactions, as you saw here, that whole concept is still the same. There's a value of the exchange, and you need to determine what that is. Same here. We determined there was a whole bunch of numbers that were presented, right? And we ended up figuring out that the revenue that we're providing for the transaction at hand, the operating activity one, is 218. Every other revenue apart from that is us acting in the capacity of a finance company. So we recognize it as interest revenue as opposed to just regular revenue. Okay? And it always helps to do your amortization schedule, do things in small chunks, visualize a T account if it helps you. It helps me, so don't be embarrassed to do a T account and be able to understand the flow of the information. This concludes the video on valuation issues with notes receivable.